Good morning and welcome to the EENERGY Group PLC investor presentation. Throughout the recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time by the Q&A tab situated in the right-hand corner of your screen. Just simply type in your questions and press send. The company may not be in a position to answer every question received during the meeting itself. However, the company can review all the questions submitted today and publish responses where it is appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Harvey Sinclair, CEO. Good morning to you, sir.
Yeah, good morning and welcome investors this morning. This is an opportunity for Chris and I to update you on what's been a very busy and productive 6 months after having obviously some significant changes to the business. So this really is a slightly different format than usual because we want to talk to you about a lot of the things we're putting in place for the business that reflects a strong outlook going forward. So whilst the last 6 months have been challenging, I think there are a number of very, very strong positive underlying key points that we want to get across this morning to investors. But before I do that, I think I want to just put some context to the backdrop. So from a trading perspective, we've had a slower than expected H1 trading performance. And there's a few reasons for this. As you know, the energy crisis in 2022 set the scene for a strong acceleration of energy transition projects. And then in the last 12 months, there has been a slight change in momentum in the market. That said, the future trajectory is extremely strong and extremely buoyant. But the last 12 months have had a few macro trends which have caused some difficulties for our market. One of which has obviously been the stabilization and then falling off of energy prices from last summer, and the second is the rise in interest rates, and both created a bit of a perfect storm that scuppered the momentum, the strong momentum that the energy transition sector was seeing for key decisions being made by our clients around big energy transition projects. And I think that's something we've seen ease off, and we'll talk a little bit about the government changes and the public sector drivers that are now back in full swing. But those two levers did create a pausing of the strong momentum we saw. And I think when you combine that with some of the internal transition changes that we were going through and the disruption of disposing what was over 50% of our business from an integrated company perspective, and then the post rebuilding of our energy services business, it's not surprising that we may have seen some knock-on effect to the current trading. And we did take this as an opportunity to pause and reset. So in Q2, there was an opportunity to have delivered more revenue, but we chose deliberately to push some of our revenue forward while we were using some of the, if you like, post-transition exit window of opportunity for us to invest in our infrastructure. And what we are now is we're in a very, very strong position where we've taken some big steps to build out the energy infrastructure for around the services business. And having restructured following the sale of energy management, we've got a stronger internal platform from which to build, in particular, the solar business, which, as you'll see, has grown significantly over the last 12 months. We've invested a lot in people to complement the technology, and we've built what we believe is a very scalable platform that's going to be able to support that step change from what we will have seen as over a 500% organic growth in solar. We've now clearly got a much stronger balance sheet. We've been able to use our balance sheet to renegotiate our supply chain, and we've seen some very, very strong changes to our benefit. And you'll see that our margins are trending upwards as we talk through the business later in this presentation. And together with our strong balance sheet, we've been able to start facilitating the NatWest funding product that we have, and we've already now successfully concluded a number of drawdowns from that NatWest facility. In the last 6 months, despite the fact that revenue itself, which, as you know, reflects the installs delivered, our actual pipeline has grown stronger in the last 6 months than any previous period. So we are sitting at a point now in August where we have got strong contracted revenues, and we are maintaining our guidance for the year despite what looks like a slower than expected H1. So I think from an investor perspective, I think I want to provide the reassurance that the underlying drivers of our business haven't changed, that we've got an extremely strong opportunity as we look forward for the year, but we've taken this opportunity to build it on a really strong platform, and I'll talk you through some of those changes in a second. So for those investors, or I guess for those on the call today that haven't had, I guess, a refresh of our proposition, having now exited the energy management product offering, we've now finessed our, I guess, proposition to customers into three very, very clear categories from which we wrap a unique proposition around. So we've always been very focused on energy reduction and the ability for us to transition our customers with capital-free solutions through the use of energy as a service focused on lighting and controls. That is a very, very strong centerpiece of our strategy, helping our customers deliver energy reduction strategies through as a service. And this division is very much focused on public sector, very much driving a leadership position in the education market, delivering strong margins, 38% and rising. And we believe that this market, as you'll see shortly, is still extremely addressable and a very strong opportunity for the business. Complementing that is our fastest growing part of our business, which is the generation vertical. And this is a very clear proposition to customers about delivering turnkey solar PV solutions across ground mount, rooftop and carport solutions, where we focus on quality and service, and we're looking to deliver risk managed solutions for customers in that mid-market 250 to 5 million pound sort of, if you like, enterprise solutions. Delivered as a service or as turnkey solutions for those that do have investment for their infrastructure upgrades, but generally speaking, combining reduction and generation as a wrap solution for our customers, largely in the public sector, which is our focus, but increasingly with solar moving into some really very exciting commercial, industrial, if you like, projects that we are starting to build our pipeline around. And then finally, our charging solution remains an important strategic opportunity for customers, but we still don't see the growth in charging that we see in reduction and generation. That's not to say that we don't see it coming. It's something where we're using as an add-on to our customer proposition at the moment, where customers typically want a handful of chargers to deal with an initial uptake of their customers or their stakeholders coming to their buildings with EV vehicles. And I think that's an opportunity for us to grow in the future. But wrapping all of our service propositions is in essence two things. One is the ability to have an off-balance sheet, simple financing solution, which we're using the NatWest for the public sector and our other panel of funders for the commercial industrial projects. And then a data insight solution, which sees us still using the MyZero license that we've kept post-transaction, that allows us to provide verification, measurement, monitoring, and carbon reporting to our customers. So differentiated from our competitors and a very strong, compelling proposition. And I'll talk about the addressable market in a while. So when we think about the market opportunity, there are a lot of key long-term drivers. We've got a new government that is clearly going to prioritise getting to net zero faster and with more vigour than the previous government. That's been a publicly stated strategy, and we're already seeing the momentum in areas such as the reduction of red tape and the ability for our education partners to sign more flexible financing agreements that don't have necessarily some of the red tape that they were seeing 12 to 18 months ago. So a very strong, favourable regulatory and policy-driven environment is going to be fantastic for the public sector. The public sector is probably the sector which is going to be influenced more to get to net zero than any other vertical in our market. And so for us, that's a very strong inflection point. And after, frankly, a 12-month softening of people's focus on net zero, we see there being a very strong race now to net zero in 2030 as people start to get back focused, having solved some of their own economic internal issues around their own business challenges, to getting to net zero. So anything we can do to help our customers get there faster and more efficiently with more value is for the good. Solar, clearly the hottest energy transition topic in the market at the moment, and we believe we put ourselves in a very strong position. The energy market is still volatile, and volatility for us is a good thing because it provides uncertainty. And when you're talking to customers about driving on-site generation, what you're really talking about is security of supply of energy for that customer for a percentage of their consumption profile. So typically we see our customers removing the reliance of the grid by about 30%. So a typical hospital or secondary school, for example, or large public sector building would typically see a third of their energy consumption come off their profile by going off grid through an on-site generation scheme, and that effectively takes a third of their volatility away because they've got a 10-year index-linked clear view of their energy profile going forward. In a capital-constrained market and where budgets are tight and where subsidies can only go so far, what our capital-free solutions allow our customers to do is to do more than one energy transition measure. So despite the fact we see the government focused on grants and subsidies, which we can take advantage of, the customers that we see have always got more than one energy transition driver, whether that's solar versus an energy reduction strategy. Our solution means that they can do two at the same time. Customers are also very much more focused around one partner for one turnkey solution rather than multiple partners and multiple execution challenges. And increasingly, the demand for energy insights is more and more important as people start reporting on their carbon footprint and the changes they're delivering to that carbon footprint. So they're the long-term drivers. And then in terms of the market opportunity, we took the opportunity since January to deploy a number of independent research pieces of work to ascertain what the remaining addressable market was in education and healthcare, because we didn't really feel there was clear, concise advice out there or concise data that we could really rely on. So we commissioned our own internal report, and we also worked with a partner who commissioned a strong report that gave us the reassurance that in the education market, we're still looking at 65% addressable for lighting alone, which values our market opportunity in education at over 2 billion. And we think that market has got a decade still to run. Clearly, there's going to be a big chunk of that transition between now and 2030. But the research shows us that the long tail is a decade's worth of transition. Regarding the healthcare market, whilst there has been some key project transitions in this space, we're still talking about a 50% addressable market. So we've got a multi-billion-pound opportunity for EENERGY in a favourable government and regulatory-driven market where there is a huge driver to get to net zero by 2030, and where we've got a very, very strong brand that's differentiated in the public sector in particular, with credibility and with the ability now to scale, having invested quite heavily in a lot of infrastructure systems and processes. The other key area that we've been investing in that's part of the market opportunity, and it's in relation to the way in which some of our competitors have grown, which has been a different route to market that EENERGY has followed, is the fact that we've always had a direct sales solution. We've always had a very, very successful platform for scaling strong conversion rates, strong incoming opportunities, and an operating model that's all driven around direct sales. we've now spent the last 6 months building out a platform which is framework ready, and where we have now onboarded ourselves with a dozen plus very key frameworks across different segments of the public sector, and a team behind that which is able and ready to respond to frameworks. And when we look at our competitors in the market, we see that 80 to 90% of their growth has come from framework-driven opportunities, whereas at EENERGY for the last 4 years, over 95% of our growth has come from direct sales. We believe this could be a strong internal inflection point where we're able to combine the best of both worlds with a strong new team on frameworks and the ability to start bidding on 7- and 8-figure projects, and also maintain the direct sales strategy that we've been having to date with great success. To give you some highlights and just to recap on a number of quite specific things we've been doing, which we're very proud of. The business itself was integrated with energy management, okay? And so when we talk about integration, we're talking about finance, operating models, we talk about CRM systems, we talk about the project management modules. We had to disentangle that in order to be able to exit the energy management business. And as part of that process, to keep that as least disruptive as possible, we allowed that business to go with a number of versions of platforms. And the opportunity therefore arose for us to rebuild an integrated finance ERP system under NetSuite, which Chris can talk about. That's been a really big, significant investment and allows us now to have a lot more robust, a lot bigger and a lot stronger, robust handle on our finances and our balance sheet. We rebuilt our operating CRM system. We've created a new end-to-end Salesforce and project management workflow stream for customers that integrates with our ERP system. And that will stand us in great stead as we look to grow over the coming years, as we look to grow and expand the business. We have and continue to invest quite a lot in our proprietary app. And this is a really important point for investors to recognize. We see our business as having two parts to it. We're a developer on one hand, and we're an EPC provider, which is effectively a sophisticated contractor, which is the EPC standing for engineering, procurement, and construction. So when I think about our business in two parts, we need a fix on the game in both parts. So for the development model, what stands us out as being better and more value add than our competitors? One is our route to market. One is our brand. One is our track record. The other is our operating model internally, about how quickly and how efficiently can we take an interested opportunity and a qualified opportunity through to an investment grade proposal. In order to do that, we've automated and systemized and created technology that allows us to collect data on sites more quickly and more accurately, and to use AI and technology to automate that data into a specification and therefore investment grade proposal, where we can convert 80 to 90% of all our opportunities automatically to a proposal in days versus weeks. And we know that our conversion rates are much, much stronger when we can get a customer an investment grade proposal from when the clock starts ticking on a qualified opportunity. And so that investment in the app is super important for us. And as we start to expand that from the reduction division through to the renewables offer, we also start to think about things like the project management, procurement, and financing modules all being part and parcel of that app, so that we can scale both regionally and into other product sets. Touching again on the frameworks, we've invested in a platform that allows us to access every single framework bid and tender automatically as it comes through the marketplace. And we've got a system in there to sift and select. And just to reflect on the solar division, that business will have grown 500% from a revenue perspective year on year on a like-for-like basis. Now, in order to ensure that both that opportunity is sustainable and that we can deliver a high-quality, scalable solution for our customers, we've clearly had to upscale our resource internally from a management perspective, but also from a technical capability perspective. So the team that originated out the solar proposition 18 months ago was part and parcel of our energy services team. They're still very much a key part of our solar structure, but we've hired some seriously skilled and experienced talent into our business that have been building solar renewables businesses for the last decade plus for some of our competitors and some of our other competitive type businesses. So we've now got an upgraded and strong team, but we've also been able to upscale a lot of the supply chain and for engineering procurement capabilities of that team to enable it to grow. Crispin will talk to you a little bit about the group restructure, but also around the balance sheet. As you know from our announcement last week, we've taken this opportunity to clean up our balance sheet, and that's going to allow us to have a much cleaner financial reporting and also governing strength behind the way in which we report going forward. NatWest is fully embedded. We're excited about the facility. We're starting to see real strong traction. We've had 2 drawdowns now, and we're expecting to start really getting some momentum behind that now as we start to expand that out across all of our product sets and across both education and healthcare. So we're delivering a really, really strong pipeline now that, as you know, have a 6-month to 12-month gestation period. So the work that we've invested in for H1 will start to yield really strong results in H2 and for next year's H1. So we're entering H2 with extremely strong momentum, strong conversion rates, which are up year on year, and a really robust forward order book. And when I look at the H2 revenue forecast, we can see that and we'll go through it in a second, but the workflow and the revenue that we've got locked in more than covers our Q3 expectation for the best Q3 we've ever had. So we're extremely excited about H2, and we're going to start seeing cash generation come forward. In terms of sort of a trading summary, I think I'll hand over to Crispin, who can talk you through some of the numbers, and then I'll come back and look at some of the other elements.
Thanks, Harvey. So as Harvey has outlined, H1 results were challenging. These were impacted by the constrained balance sheet prior to the completion of the sale of energy management during Q1, and also challenging market conditions as a result of a reduction in energy prices and at the same time as an increase in the cost of finance. The core revenue for the energy services business of 6.2 million was therefore down from 11 million on a like-for-like basis in the previous year, and with an adjusted EBITDA loss of 2.1 million for the group, down from a profit of £500,000 on a like-for-like basis last time. The operating cash flow for the period reflects this, with strong cash generation expected in H2, mirroring the forecast earnings profile for the year. As Harvey mentioned also, following the disposal of energy management, we have taken the opportunity to conduct a full review of the group's balance sheet and structure. Following this review, we are expecting to take an exceptional charge of up to 2.5 million at the half year, and further detail of this will be provided in the interim accounts. We've been pleased to see a strengthening in the market during the period, and the political certainty given to decision makers following the UK elections has further supported this. That all gives the business strong momentum coming into H2, and we are maintaining full year revenue guidance.
Thanks, Crispin.
So I was just going to talk to this slide as well, Harvey, on the outlook. So the H2 forecast is underpinned by a robust contracted forward order book coming into the period, which covers 44% of forecast H2 LED revenue, which was contracted as at the date of the trading update. And that's consistent with our target to maintain at least a 3-month contracted forward order book in LED. 75% of our forecast H2 solar revenues were also contracted. And as you'd expect, those contracted revenues have further increased in the last few weeks since the trading update. We have good coverage on the new business requirement for H2, following record pipeline growth in H1, as Harvey mentioned. And I'm also pleased to say that management actions during H1 are delivering improving margins for both LED and solar. And we expect this trend to continue through H2 and beyond. So whilst the H2 revenue forecast does represent a step up from H1, the robust forward order book and strong pipeline allows the board to maintain the full year revenue guidance at 25 to 26 million. Thanks, Harvey.
Thanks, Crispin. So just to recap on a few interesting points around the business. I mean, from my perspective, I think we've got the best team we've ever had. I think morale is at its all-time high. I think we've got a really exciting strategy and a really exciting market. This race to 2030 is going to set ourselves in for an explosive market opportunity for the next 6 years. I've got absolutely no doubt in my mind that this brand is well positioned to really scale within this market opportunity. And I think there's going to be some really big and exciting projects that EENERGY will set itself up to win over the coming 6 months. The pipeline growth over the last few months has proven to me that the sluggish nature of the last 12 months is behind us in terms of that ESG fatigue we were starting to see post-energy crisis. That's definitely been shaken off in the market, and our supply chain partners starting to feel the same thing in the market generally. For us, being public sector focused is a really super exciting place to be. I think the new government has got an accelerated and more invigorated strategy, and I think they're here to set themselves up as being an ESG, net zero, climate action orientated government, and I think that's just a phenomenal thing for us. The opportunity to pivot from our education background has been clearly a big opportunity for us over the last few months, and that pivot to healthcare with having won, a phenomenal contract with Spire earlier in the year, which is going well incidentally, allows us to really set ourselves up as the #1 public sector energy services provider in the UK. And really that's my goal, which is to build market leading brand, differentiated through technology, focused and centered around quality and service. So I always say, you can choose price, quality or service, and you can choose 2 out of 3. We do not sell on price. We do not set ourselves up to try and be the cheapest or the most value orientated from a pricing perspective. We set ourselves up as being value orientated around long-term value across the length of the contract, and we pride ourselves on quality and service. So very health and safety focused, which I think is the most important thing for solar businesses. And the team that we built reflects the highest possible quality that we found in the market. Leveraging finance for us is at the center point and part of our business. The NatWest facility was difficult, expensive, and complicated to put in place. We see that as a massive barrier to entry. It took longer to put in place and longer to implement than we would have liked, partly because we had so much going on in the business. But now it's in place and the system is well oiled for growth. I think there's nothing stopping us from really leveraging that platform. And then in terms of our investment, I've talked about the platform, the systems and technologies. In order for a developer to become scalable, there's got to be technology, there's got to be a platform-based focus and mindset, and that's what we now have. So just to reiterate, I'm the most confident I've been around the future trajectory of this business, and it's been great to have the opportunity and I guess taking the opportunity of the last few months to stabilize and put ourselves up for success going forward.
Perfect. Harvey, Crispin, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab, which is situated on the top right-hand corner of your screen. But just while the company take a few moments to view the questions that have been submitted today, I'd like to remind you that recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. As you can see, we have received a number of questions throughout today's presentation. And Katie, at this point, if I could just hand over to you to share the Q&A, that'd be great. And then I'll pick up from you at the end.
Thank you very much. Thanks, Harvey and Crispin, for the presentation. We've had several questions come in already. So you touched on it during the presentation, but what impact are you expecting or have you already seen from the new government?
Yeah, great question. So as I did touch on it, I think there's 2 key points here. One is the the reduction of bureaucracy around governing governance of paperwork and governance of accounting rules. I think there's been a relaxation for the education sector in particular around what format our customers can sign on long-term kind of financing arrangements. That's going to be really beneficial to us as customers feel less nervous around signing up to certain types of agreements. And the other is more demand from the government to the public sector to take net zero more seriously and to put it on top of their agenda. So if there was any form of hesitance or deprioritization, that's now being firmly reprioritized. So we're seeing a reprioritization of net zero, increasingly grant-focused market, but that can only go so far, and a more lenient, I guess, environment for them to provide private commercial companies the opportunity to support the government's drive to net zero.
Thank you, Harvey. Another question that's come in is, what's the opportunity kind of around battery storage?
Great question. So mid to long term, this will be the biggest value driver for the energy sector that we've ever seen. So as solar becomes more deployed and our built environment starts to reduce its energy wastage and starts to populate the ability to generate on site, it's all going to be around how do companies get off grid and how do companies store their solar energy and trade it at a discount to the market on grid. So our focus has always been a land grab of customers. We've got over 1,000 customers and we're looking to acquire somewhere between 250 and 350 customers a year. Over the next 3 years, the cost of a battery will reduce by 50%. We're seeing evidence from the Far East that on average, we're seeing a 15% reduction on year battery costs. The analysis we've done shows us that in order for a battery solution to be economically viable, financeable, and to provide the same kind of valued metrics financially to a customer and to a funder, the battery cost has to reduce by 50%. The moment that happens, the whole concept of microgrid, which is creating traded electricity power in between communities and having each site being able to be more self-sustainable, happens in the blink of an eyelid. So for us, being able to build a custom base that we can layer in a funded battery solution for customers that have got solar, whether it's our solar or someone else's solar, is going to be a phenomenal opportunity and a massive market value driver, and will give us another decade's worth of growth.
Thank you. And on the solar aspect of that, is there, someone's just asked about kind of what the barriers to entry are for solar in your target market?
So I see the solar market into three parts. You have utility scale, investment grade, let's call it grid scale solar solutions, which are 10 meg or more. That market is something we don't focus on. And then you have the SME market, which is 10 kilowatts to 50 kilowatt schemes. So think SME, 10 to 50,000 pound solutions. This part of the market we also do not focus in on for three reasons. Firstly, that market is low barrier to entry. Anyone who has a customer base that provides any form of mechanical, electrical services, so electricians, scaffolding companies, are all kind of flooding that market with low-cost solutions, very low quality, low service, race to the bottom on price. We're staying well away from that market. Our market is the mid-market, in particular, sort of 250,000 up to £5 million projects. These projects have complex supply chain needs, which have high barriers to entry for small companies because of the nature of the length of investment you need to invest up front, the nature of the supply chain, and the revenue profile and cash profile of these projects. To run a strong solar business model, you have to have a strong balance sheet, which is the very reason why we're so excited about the post-transaction from energy management and what we've got in front of us. The second area is these large schemes are all around risk management. You've got a lot of operational risk for these customers if something goes wrong on roofs. And I think there is a reluctance for customers, commercial, industrial, or public sector, to take the risk on companies that have not got a track record of running large-scale mid-market solar solutions. So from our perspective, the barrier to entry is massive in our target market, partly because of the maturity of the market, the financial constraints, the cash flow profile, and also the credibility of having proven they've done it before. We also see that this market is quite thinly served from a competitive perspective, and we don't really see we've got much more than a dozen or so credible competitors in our mid-market public sector vertical.
Thanks, Harvey. And actually, following on from that, someone's asked, do you have any plans to expand your operations beyond the UK, particularly in the markets where renewable energy and energy efficiency are gaining traction?
Yeah, we do. But it's all about timing. We talk a lot about our growth aspirations, and I think this is a year for stability, reinvestment, and pivoting for growth. We're going to have seen strong growth this year. By the time we finished the year end of December, we'll have delivered a huge growth in solar. If we can deliver that and set ourselves up for another strong year in the UK and Ireland for next year, I think there is an opportunity to go beyond that into some very exciting target markets that we can explore in the coming months. But for now, next 12 months, very much UK focused, strategy that I've set out, but yeah, aspirations to go further in the years to come.
Thanks, Harvey. Someone was just wondering if you could possibly provide a bit more detail and context around the Spire contract, if at all, kind of the margins, expected profitability, and whether there are any similar large-scale opportunities in the pipeline.
Sure. Look, the Spire contract is very complex. It's a 43 property rollout across the whole of the UK. Margins are on plan as per our original budgeting. We are halfway through the contract. We expect to complete it in the next 2 to 3 months. We got a good relationship with our customer. We've invested heavily in the contract with some key people, and I think that we're very focused on delivering that customer an extremely high quality service. In terms of other large-scale projects, we have got a number that we're looking at of 7-figure projects plus. We're starting to very much focus in on tender opportunities in that £1 to £5 million contract value bucket. And as you can appreciate, they're pretty big needle movers. If we're working at 25% margin for a solar project, let's say at the sort of the midpoint, on a £5 million project, that's quite a big needle mover for the financial outcome without investing any further resource into the business. So yes, I'm very much focused on large 7-figure deals now.
Thanks, Harvey. Following the sale of their energy management division and the repayment of the debt, someone's asked how the company is prioritising the use of capital. Are there any plans for further debt reduction, share buybacks, or any kind of specific investments in growth areas at all?
So, just for my part, I think the key is around ensuring that we have a healthy balance sheet, but at the same time push our creditors hard to make sure that we optimize our cash flow profile. So we are looking at a procurement strategy for our creditors that allow us to leverage our balance sheet so we don't have to use it unnecessarily. I think we've clearly removed the debt in our business, which is a strong thing. We haven't at the moment got a strategy to invest in our own projects. We are looking at ways in which we can leverage the NatWest facility, and that's been part and parcel of the way in which we've used our balance sheet. Crispin, do you want to add to that?
No, I think that's exactly right, and I think we spoke about that. The opportunity to leverage the balance sheet strength to improve margins, and I think the NatWest facility is a good example of that. But yeah, it's helping us drive growth in the energy in that energy services division.
Thanks both. Again, this was touched on in the presentation, but just a question about how strong is cash flow now and the specific impact of the 2.5 balance adjustment.
Yeah, so should I take that one, Harvey?
Sure.
So yeah, as we highlighted in the presentation, we're the cash flow profile for the year broadly mirrors the earnings profile for the year. So we're forecasting strong cash generation for H2, and the full breakdown of the balance sheet as at the period end at the end of June will be provided in the interim accounts. That's also the case for the 2.5 million adjustment we've talked to. That's a non-cash adjustment. That's sort of legacy balance sheet adjustment.
Thanks, Crispin. And just a final question, unless any other questions come in during the answering of this, but it's just about the type of period. Over what type of period do you expect the NatWest facility to be utilised over? And is there any forward looking as to what happens post the facility?
So I think that based on our sort of 3-year plan for deploying third-party capital into projects as across solar and our energy reduction division, I think that it's reasonable to think that the facility is probably a 2 to 2.5 year deployment cycle. I think the partnership with NatWest is going from strength to strength, and I think that there is an appetite for delivering growth beyond this. And I think, in fact, if we can accelerate the drawdown of this facility with the profile of customers we've got, it's a long-term partnership we want to explore. This is not a one facility partnership. We want to be doing much more with NatWest, more broadly and more quickly. So I think yes, watch this space.
Great. Thank you very much, Harvey and Crispin. That's all the questions.
Perfect. Harvey, Crispin, Katie, so thank you for answering all those questions you can from investors. Of course, the company can review all the questions submitted today and will publish those responses on the Investor Meet Company platform. But just before redirecting investors to provide you with their feedback, which is particularly important to the company, Harvey, could I just ask you for a few closing comments?
Sure. So good to have had the opportunity to update investors today. It's been a really busy 6 months. We think we're in a fantastic position now with a really strong team, great pipeline, great regulatory environment. The sprint to 2030 has got everyone very excited in our business, and we've got an incredibly strong outlook for H2. So I'm looking forward to updating investors in a couple of months at the end of sort of the interim period, where we can lock in that commitment of our revenue for H2 and start looking for increased cash generation going forward as well. So yeah, very excited about the future.
Harvey, Crispin, thank you once again for updating investors today. Could I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of EENERGY Group PLC, we'd like to thank you for attending today's presentation, and good morning to you all.